Welcome back, students and scholars. In this session, we are moving into the special issues and disclosure traps of ASC 230, Statement of Cash Flows. The basic idea of ASC 230 is simple: follow the cash. But as we all know, accounting standards behave very politely in theory and then become slightly dramatic when real facts arrive. Today we will focus on the areas where even trained preparers can make mistakes: gross versus net reporting, hedging cash flows, foreign currency effects, consolidated cash flow statements, and disclosure alerts. By the end of this video, you should be able to look at unusual cash flow facts and say, calmly and professionally, I know where this belongs. Before we enter the technical details, let us build the learning path. First, we will study netting rules because ASC 230 generally wants gross cash receipts and gross cash payments shown separately. Second, we will look at presentation traps, including cash flow per share and discontinued operations. Third, we will handle hedge and foreign currency issues where classification can change depending on the facts. Fourth, we will discuss consolidation because consolidated cash flows require a group level view, not entity by entity thinking. Finally, we will close with disclosure alerts and practice risks. Think of this video as the quality control layer of ASC 230. The first videos taught you the map. This video teaches you where the potholes are. Let us begin with the gross reporting rule. Under ASC 230, the starting point is that gross cash receipts and gross cash payments should be reported separately. This matters because a small net number can hide very large activity. For example, if an entity borrows 100 million and repays 98 million, showing only a 2 million net inflow would hide the scale of financing activity. Users, lenders, analysts, and auditors need to see the true cash movement, not just the final leftover number. So the memory rule is simple: gross in, gross out, separately presented. Netting is not the default. Netting is like using an accounting shortcut, sometimes allowed, but if you take it without permission, the reviewer may politely hand you a comment letter. Now, when is netting allowed? ASC 230 permits net reporting only in narrow situations, and all three conditions must work together. The activity should involve quick turnover, large amounts, and short maturities. The short maturity condition is especially important, usually 3 months or less from the original maturity perspective. This is not a casual convenience rule. You cannot say the net number looks cleaner, so let us use it. No, ASC 230 is not asking for interior design. It is asking for faithful reporting. If any condition fails, gross reporting comes back as the safer and usually required presentation. This is why the three conditions should be treated like a gate. If one lock does not open, the netting gate stays closed. Common examples of permitted net reporting include certain investments, loans receivable, and debts, but only when the original maturity test and related conditions are satisfied. Notice the phrase original maturity. That means we look at maturity from the date of acquisition or issuance, not merely the remaining maturity at the balance sheet date. A 2-year note with 2 months remaining does not magically become a 3-month instrument. Accounting standards are not fooled by late-stage rebranding. For investments, short-term purchases and maturities may qualify for net presentation. For loans receivable and debts, similar logic can apply where transactions turn over quickly and involve large amounts. But if the item does not meet the narrow conditions, report the cash receipts and payments gross. Next, let us connect ASC 230 with discontinued operations under ASC 205-20. If a component is classified as discontinued operations, the cash flow statement still needs to reflect the related cash flows. ASC 230 handles the cash flow presentation framework, while ASC 205-20 handles the discontinued operations criteria and disclosure requirements. The key point is coordination. preparer should not treat the cash flow statement as isolated from the discontinued operations note. Cash flows may need to be disclosed by type of activity, operating, investing, and financing, or presented in a way that clearly links to the discontinued operation. This is a cross-reference alert, not a full discontinued operations lesson. The practical message is simple. When there is a disposal, do not let ASC 230 and ASC 205 to 200 behave like two departments that never speak to each other. Now comes a very testable trap: cash flow per share. Under ASC 230, cash flow per share information should not be displayed in the financial statements. Students often confuse this with earnings per share under ASC 260. EPS is required for certain entities, but cash flow per share is not a GAAP financial statement display item. It may appear in investor presentations or non-GAAP style discussions outside the GAAP financial statements, but inside the financial statements, it does not belong. This is one of those rules where the standard is not asking for your creativity. If a question says cash flow per share displayed in the notes, be alert. ASC 230 is not being tricky here. It is simply checking whether you read the word cash and forgot the word per share. Financial institutions create another important reminder. ASC 230 gives the general framework for the statement of cash flows, but certain financial services entities may require specialized guidance, especially under ASC 942. Banks, savings institutions, credit unions, and similar entities often have cash flow patterns that are very different from ordinary manufacturing or service businesses. Loan origination, deposit activity, securities portfolios, and short-term financial instruments can create situations where the general ASC 230 map needs industry-specific adjustment. So before applying a classification rule mechanically, identify the entity type. For most entities, ASC 230 gives the foundation. For financial institutions, apply ASC 230 first, then check whether ASC 942 modifies or adds guidance. In practice, entity scope is not a footnote detail. It can change the analysis. Let us move to hedging cash flows. Under ASC 230, cash flows from derivative instruments accounted for as fair value hedges or cash flow hedges may often be classified in the same category as the cash flows from the hedged item. This alignment avoids a mismatch. For example, if a derivative is hedging an investing activity, it may make sense for the related hedge cash flows to follow the hedged item rather than appear somewhere unrelated. But there is a condition. The entity must disclose its accounting policy for classifying derivative cash flows. This is not an optional decoration in the notes. The policy disclosure supports the classification approach. A good exam habit is to ask two questions. Is hedge accounting actually designated, and is the classification policy disclosed? If yes, alignment may be appropriate. Now we meet the financing element exception. If a derivative contains an other than insignificant financing element at inception, the borrower classifies the related derivative cash inflows and outflows as financing activities. This exception overrides the normal follow the hedged item idea. Why? Because the derivative is not only managing risk, part of the arrangement behaves like financing. This can happen when off-market terms create the effect of one party lending to the other through the derivative structure. The assessment is made at inception, not after the fact when the numbers look inconvenient. This is a serious classification trap. If there is a financing element, do not force the derivative into the hedged item category. ASC 230 is basically saying, nice hedge, but I can see the financing hidden inside. What happens if hedge accounting ends? After discontinuance, the classification of subsequent cash flows changes. During an active hedging relationship, the derivative cash flows may follow the hedged item, assuming the required conditions are met. But once hedge accounting is discontinued, later cash flows are classified based on the nature of the derivative instrument itself. This does not necessarily mean the derivative disappears from the balance sheet. It may still exist, but the aligned hedge classification no longer applies to future cash flows. That is why documentation is important. The preparer must identify the date of discontinuance and classify cash flows after that date consistently. In simple words, the hedge relationship had a membership card, and once it expires, the instrument must stand in line under its own nature. Foreign currency cash flows create another bridge, this time to ASC 830. ASC 230 sets the cash flow statement framework, but foreign currency transactions and foreign operations require ASC 830 guidance for translation mechanics. The effect of exchange rate changes on cash and cash equivalents is typically shown separately as a reconciling item, not mixed into operating, investing, or financing totals. For individual foreign currency transactions, the cash flow is translated using the exchange rate at the date of the cash flow. For foreign operations, a weighted average rate may be used as a practical expedient in appropriate cases. The key teaching point is this: exchange rate effects are real, but they are not an operating, investing, or financing activity. They reconcile the cash balance across currencies. Now let us talk about consolidated cash flows. A consolidated statement of cash flows is usually prepared after the consolidated balance sheet, consolidated income statement, and retained earnings information are complete. Why last? Because the cash flow statement depends on changes in balance sheet accounts, income statement items, and equity movements. If the consolidated balance sheet or income statement contains an error, the cash flow statement often exposes it because it must reconcile beginning cash to ending cash. The slide shows the preparation sequence clearly: balance sheet, income statement, retained earnings, and then consolidated cash flows. A practical control is to first confirm that the change in cash on the cash flow statement agrees with the change in cash and cash equivalents on the consolidated balance sheet. If it does not tie, do not decorate the statement. Fix the accounting. Consolidation also requires a filter mindset. Only cash flows with external parties survive in the consolidated statement of cash flows. Transfers between the parent and subsidiary or between subsidiaries are internal movements inside the consolidated group and must be eliminated. The same logic applies to intercompany dividends and unrealized intercompany profits. If a subsidiary pays a dividend to the parent, that may be cash movement in the separate books, but from the consolidated group's perspective, cash simply moved from one pocket to another pocket of the same coat. It is not an external financing outflow. Non-controlling interest effects may require careful treatment depending on the transaction. The memory anchor is simple. Consolidation is a boundary test. Internal flows stop at the filter, external flows pass through. The disclosure and practice alert is very important for professional work. The statement of cash flows is a frequent source of SEC comment letters and audit questions, especially when entities classify unusual items, report major period-to-period changes, or apply policies inconsistently. Preparers should explain significant cash flow variances with specific drivers, not vague phrases like due to business reasons. Material classification choices such as contingent consideration payments, insurance proceeds, debt issue costs, or debt extinguishment costs should be supported by policy analysis and documentation. Also, watch adverse trends. If net income looks strong but operating cash flow is weak year after year, analysts and auditors will ask questions. Cash flow does not gossip, but it definitely tells stories. Make sure the story is supportable before filing. Let us close this video with the 5 main takeaways. First, gross reporting is the default. Netting is narrow and must be justified. Second, cash flow per share is not displayed in the GAAP financial statements, even though students often confuse it with EPS. Third, hedging cash flows need careful analysis because the normal aligned classification can be affected by policy disclosure, financing elements, or discontinuance of hedge accounting. Fourth, consolidated cash flows include only external cash movements, so intercompany flows are eliminated. Fifth, disclosure matters. Judgment documentation, variance explanations, and policy disclosures are not optional extras. They protect the quality of reporting. If this video helped you, please like it, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building serious free education. In the next video, we will apply ASC 230 through practice questions, multiple choice and short answers.